Well, I think that the U.S. does seem to be trending a little ahead of Europe, I think, as it has in the hotel sector over the last 10 or 20 years. I would say the trends in the U.S. are not as positive in the sense that we are seeing RevPAR declines in many of our major cities. I think generally we feel as though we're at the peak of the cycle. I think that I'm sorry to put such, I don't mean a negative bent on this, but
I'm glad to ask you, Rick.
I think our clients in the U.S. are generally net sellers. I think they're being very cautious. Deals tend to fall out of contract much quicker and much more often than they have in the past. And I think most of our private equity clients, frankly, are looking toward Europe for yield and return. That in the U.S. is, I won't say quickly disappearing, but it's becoming much tougher. As you see RevPAR decline around 4 or 5%, we also have significant increases in cost in many of our many of our urban cities, which is essentially, of course, decreasing margins. And much of that comes from labor and employment and union activity. So I think we're a little ahead of the game. Like I said, most of our private equity clients, frankly, are much more committed to Europe right now. And that's kind of where we see the opportunity.
And just to, is that coming from the point that Jochen made, which is that this is the sort of online travel aspect of it that's bringing those margins down, or is that really to do with the employment factors?
Much more employment.
Is it?
I think that the OTA impact we've seen for quite a while because we're a managed country, not a ground lease country. I think it's generally the day-to-day operation is quite a bit different. But yeah, it's much more so because of taxes and employment as opposed to the OTA. Everybody, of course, is impacted by the OTA. I personally think that the Marriott-Starwood merger is, although perhaps very favorable for current owners, I think it'll be a disaster for owners down the road. I think Marriott and Starwood are going to have, they've always had leverage, but now the leverage is just going to be unbearable in new deals. So hopefully they'll have a positive impact on reducing the OTA cost as a percentage of revenue, but we'll see.
What we've seen over the last 10 years in the European investment space is a real change in the profile of capital as well, right? You see a lot of investors that you could probably count on 1 or 2 hands of the active cross-border investors in Europe probably 10 years ago. And now you have new investors coming from the US, from Asia, from Middle East. You have institutional players getting involved. And obviously part of that is some of the things that Eric was talking about. Part of that is people chasing yield and looking into, extending out of core into value add, extending out of some more core commercial real estate, moving into hospitality, and then even within hospitality, moving up the risk curve from leases up into management contracts, and actually beyond management contracts to platforms, which is, a lot of the capital that's coming in, they're looking to come in, especially from the Asian side, are looking to achieve some kind of long-term strategy, right? So they're looking to have an operating platform in place. They can control a bit more of the value chain and potentially have their own brand composition, et cetera. So you are seeing a lot more players, which gives you more liquidity. It's driving down yields. It's making it more difficult for us to get the kind of returns that we would like, which is then in some cases actually pushing down yields. In many cases, maybe to the surprise of investors coming over from the US, much lower yields in Europe than what you see on a comparable product in the US. So you wonder why would people be chasing lower yields in Europe rather than higher yields in established markets in the US? And I think it could be for a number of reasons, but people have different views on RevPAR cycle, where they are in the US, which is obviously pretty late stage, versus different countries in Europe, which is at a more early stage. So we'll see. So I think, platforms, new players, low yields, pushing people out into whether it's niche products, niche markets. You were at that stage in the cycle now where people are still really hunting yield and trying to find where they can find it. The balancing act there is obviously you don't want to get caught on the backside of the liquidity of the cycle if you move out into those parts of the market. So obviously you have to be step by step.